All right, there is the Fed Chair, Janet Yellen. Let's go ahead and listen in.
Good afternoon. Earlier today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/4 to 1/2%. This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero to support the recovery of the economy from the worst financial crisis and recession since the Great Depression. It also recognizes the considerable progress that has been made toward restoring jobs, raising incomes, and easing the economic hardship of millions of Americans. And it reflects the committee's confidence that the economy will continue to strengthen. The economic recovery has clearly come a long way, although it is not yet complete. Room for further improvement in the labor market remains, and inflation continues to run below our longer-run objective. But with the economy performing well and expected to continue to do so, the committee judged that a modest increase in the federal funds rate target is now appropriate, recognizing that even after this increase, monetary policy remains accommodative. As I will explain, the process of normalizing interest rates is likely to proceed gradually, although future policy actions will obviously depend on how the economy evolves relative to our objectives of maximum employment and 2% inflation. Since March, the committee has stated that it would raise the target range for the federal funds rate when it had seen further improvement in the labor market and was reasonably confident that inflation would move back to its 2% objective over the medium term. In our judgment, these two criteria have now been satisfied. The labor market has clearly shown significant further improvement toward our objective of maximum employment. So far this year, a total of 2.3 million jobs have been added to the economy, and over the most recent 3 months, job gains have averaged an estimated 218,000 per month, similar to the average pace since the beginning of the year. The unemployment rate at 5% in November is down 0.6 of a percentage point from the end of last year and is close to the median of FOMC participants' estimates of its longer-run normal level. A broader measure of unemployment that includes individuals who want and are available to work but have not actively searched recently, and people who are working part-time but would rather work full-time, also has shown solid improvement. That said, some cyclical weakness likely remains. The labor force participation rate is still below estimates of its demographic trend. Involuntary part-time employment remains somewhat elevated, and wage growth is yet to show a sustained pickup. The improvement in employment conditions this year has occurred amid continued expansion in economic activity. U.S. real gross domestic product is estimated to have increased at an average pace of 2.25% over the first 3 quarters of the year. Net exports have been restrained by subdued foreign growth and the appreciation of the dollar. But this weakness has been offset by solid expansion of domestic spending. Continued job gains and increases in real disposable income have supported household spending, and purchases of new motor vehicles have been particularly strong. Residential investment has been rising at a faster pace than last year, although the level of new home building still remains low. And outside of the drilling and mining sector, where lower oil prices have led to substantial cuts in investment outlays, business investment has posted solid gains. The committee currently expects that with gradual adjustments in the stance of monetary policy, economic activity will continue to expand at a moderate pace, and labor market indicators will continue to strengthen. Although developments abroad still pose risks to U.S. economic growth, these risks appear to have lessened since last summer. Overall, the committee sees the risk to the outlook for both economic activity and the labor market as balanced. The anticipation of ongoing economic growth and additional improvement in labor market conditions is an important factor underpinning the committee's confidence that inflation will return to our 2% objective over the medium term. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, was only 0.25% over the 12 months ending in October. However, much of the shortfall from our 2% objective reflected the sharp declines in energy prices since the middle of last year, and the effects of these declines should dissipate over time. The appreciation of the dollar has also weighed on inflation by holding down import prices. As these transitory influences fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the medium term. The committee's confidence in the inflation outlook rests importantly on its judgment that longer-run inflation expectations remain well anchored. In this regard, although some survey measures of longer-run inflation expectations have edged down, overall they've been reasonably stable. Market-based measures of inflation compensation remain near historically low levels, although the declines in these measures over the past year and a half may reflect changes in risk and liquidity premiums rather than an outright decline in inflation expectations. Our statement emphasizes that in considering future policy decisions, we will carefully monitor actual and expected progress toward our inflation goal. This general assessment of the outlook is reflected in the individual economic projections submitted for this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy. Participants' projections for real GDP growth are little changed from the projections made in conjunction with the September FOMC meeting. The median projection for real GDP growth is 2.1% for this year and rises to 2.4% in 2016, somewhat above the median estimate of the longer-run normal growth rate. Thereafter, the median growth projection declines towards its longer-run rate. The median projection for the unemployment rate in the fourth quarter of this year stands at 5%, close to the median estimate of the longer-run normal unemployment rate. Committee participants generally see the unemployment rate declining a little further next year and then leveling out. The path of the median unemployment rate is slightly lower than in September. And while the median longer-run normal unemployment rate has not changed, some participants edge down their estimates. Finally, FOMC participants project inflation to be very low this year, largely reflecting lower prices for energy and non-energy imports. As the transitory factors holding down inflation abate and labor market conditions continue to strengthen, the median inflation projection rises from just 0.4% this year to 1.6% next year and reaches 1.9% in 2017 and 2% in 2018. The path of the median inflation projections is little changed from September. With inflation currently still low, why is the committee raising the federal funds rate target? As I've already noted, much of the recent softness in inflation is due to transitory factors that we expect to abate over time, and diminishing slack in labor and product markets should put upward pressure on inflation as well. In addition, we recognize that it takes time for monetary policy actions to affect future economic outcomes. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly at some point to keep the economy from overheating and inflation from significantly overshooting our objective. Such an abrupt tightening could increase the risk of pushing the economy into recession. As I've often noted, the importance of our initial increase in the target range for the federal funds rate should not be overstated. Even after today's increase, the stance of monetary policy remains accommodative, thereby supporting further improvement in labor market conditions and a return to 2% inflation.
All right, yeah, you're listening there to the Fed Chair, Janet Yellen. She is delivering her remarks after the Federal Open Market Committee meeting that has now raised interest rates by 0.25%. We are joined on the set for analysis by Hilary Kramer and David Nelson. You guys have been with us for the last half hour. What do you make of the chair's comments?
Kind of as expected. The market actually started to rise a little bit during that. Like we were talking about earlier, it's going to be data dependent. I think she's going to move very, very slowly. The one thing that really struck me, and I wrote it down, they're not looking for inflation to get to 2% until 2018.
Yeah.
That's a long way off. So they
Yeah.
must have really poor prospects for things like oil and commodities right now to drive it higher.
That's right. And Janet Yellen did make the point about employment that we were discussing earlier, which is that it's tepid. You know, she discussed the part-time and the underemployment, and it's not quite where it needs to be. So she at least recognized that 5% unemployment is really a meaningless number, but that this needed to be done. But, you know, it's interesting. Anyone who's worried about their stocks and their investments really shouldn't be, because the way it works is that people start to move ordinarily into CDs when rates rise.
Right.
But in this particular case, the banks have plenty of reserves. The banks have all the money that they need. They don't need to pay more than 0.27% for a one-year CD. That's what they're paying now. In 2008, the banks were paying 3% for a one-year CD. So investors will still be forced, for better or worse, into the market.
She said it, too. She backs up what Hilary just said. She said it. We're still accommodative right now. We are not tightening. This is going back. We're trying to get to neutral. We're not even there yet.
Right, and one of the things that she pointed out was that the reason for this at this point is so that at some point down the road, we don't have to do something really abrupt.
Yeah, where you wake up one day without any warning and you have a 50 basis point hike. And that's happened in the past.
That's happened,
which
sure.
could put us back into a recession.
A couple other things that I thought that were interesting. She mentioned solid domestic spending. She said, though, that the home building isn't going on as much as they would have anticipated or they would have liked. But that the other interesting thing that I thought was that people continue to buy vehicles. People are buying cars.
They love cars.
Go America.
Yes, they do. And as long as the consumers kind of profiles that of some money to spend, investors should be thinking about stocks like McDonald's that have 3% dividend yields and that are redoing themselves, revolutionizing the way they serve and deliver and save money and go organic. And they should be thinking about the car companies. I think that Ford here is a good investment, and we continuously see
it's a decent value.
We see the numbers rising
I think the service
in those
sector,
F-150 sales.
And I think the service sector is better than other parts of the economy. So we have a split economy. The manufacturing sector is really struggling. If you're working in that area, you're really hurting right now. But the service sector, those prices go up. So you have, two divergent economies, right even here in the United States.
Right. Excellent. All right, guys, thank you so much. Hilary Kramer, Senior Editor with Absolute Capital Return. David Nelson with Belpointe Asset Management, Chief Strategist. We thank you so much for your analysis.